Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video I'm going to talk about 15 questions that you can find the answer on Investopedia.com. Investopedia.com is kind of like the Wikipedia of investing, of stocks, of anything that has to do with money. It's pretty much got everything on there that you can ever imagine about money and investing. So without further ado, let's jump into this. And as I go through these questions, I'm going to type it in the Google search, and I'm going to show you how you can easily find the answer to the question in Investopedia, the article that is in the website. So first question, what is call? And then you scroll down and bammo kazammo, here's the article right here. What is a call option? Now, without reading the article, my short answer to a call option is that when you buy a call option, you're making a bet that the stock is going to go up between now and whenever the call expires. Options have different expiration dates, and you're basically making a bet that the stock is going to go up. A call option is a contract to buy the stock at a set price. So if you buy a call option on, let's say, Twitter, and you spend a couple $100s for that call option, and that call option expires in a month, and then Twitter goes up to $40, well, you can buy the stock at $35 because you own a contract to buy the stock. That's what a call option is. And because the stock went up to $40, your contract is worth $500. So you just turned $200 into $500 in the matter of a month. Okay, so that is way easier said than done, but that is part of the allure of options. Now let's go to question number 2, and let's back scroll it here. And question number 2, what is a put? A put option. And here it is on Investopedia, and there's the article. You can go to this website, go to Investopedia, read the article. My short answer is when you buy a put option, you are making a bet that the stock is going to go down. Why? Because a put option is a contract to sell the stock at a certain price. So for example, if you bought a $35 put option on Twitter and you spent a couple $100 and the put option expires in a month, again, all options have an expiration date, and let's say the stock goes down to $30, then on the day of expiration your $35 put option will be worth $500. Why is that? Because you own a contract to sell Twitter at $35 a share. So if Twitter goes to $30 a share, then you have 100 shares of Twitter at $30 a share, but you own a contract to sell Twitter at $35 a share. That's an instant $500 profit. So if you would have spent $200 for that put, again, your put option would be worth $500. You would have more than doubled your money. So again, that's the allure of put options. Okay, now moving on to question number 3. Okay, all these questions that I'm going through are what I would call the basics of buying and selling options. So question number 3, what is option chain? And here it is on Investopedia. Now, my short answer to an option chain is that's where you go to buy or sell an option. And real quickly, just to show you what I mean, let me log on to my account, Ameritrade, TD Ameritrade, and give me a second here to fire it up. And here we are. Here's Ameritrade. And let's say that I want to buy a stock option on Twitter. So I'll put in the symbol Twitter, and this is Ameritrade. So I go to option chain right there, click on that, and there it is. This is the option chain. So you can buy and sell options that expire in 6 days, or you can go all the way out to January of 2020 and you can buy calls or puts that don't expire till January of 2020, and then there's all these days in between. So this is an option chain. I like to use the analogy of a food chain or a fast food chain or a grocery chain. When you want to go buy groceries, you go to a food chain. Well, when you want to buy options, you go to an option chain. If you just wanted to buy the stock, then you just put in the symbol and you just click the buy. But since we're dealing with options, then we go to the option chain. That's my short answer to what is an option chain. Now let's get out of this and let's go back to Google, and let's move on to question number 4. Question number 4. What price can you buy or sell the stock if the option is exercised? So I'm going to put in, what is strike price? And bammo kazammo, Investopedia.com, what is strike price? Strike price is the price at which a derivative contract, that's an option, can be exercised. The term is mostly used to describe stock and index options. For call options, and I'm reading this on purpose, the strike price is where the security can be bought by the option buyer up till the expiration date, which we kind of went over in the first question. And for put option, the strike price is the price at which the shares can be sold by the option buyer. So it's terminology, and if I were to ask the question, what is strike price, then you might scratch your head and go, huh? So I think it's better to reword the question and say, what price can you buy or sell the stock if the option is exercised? So if I was going to do this video and do a PowerPoint presentation, that's how I would word the question. But it's kind of harder to find the answer in Investopedia, typing in all those words when you can just simply put, what is strike price? The strike price is the price that you can buy or sell the stock if the option is exercised, and that is the name of the game. And so now the next question, and I actually have a little notepad in front of me, and I realize that probably the next question I was going to ask, what is premium, but I can go over that later. Instead, the next question would be, what is in the money or out of the money call? I kind of clumped it into one question, but really the main question is, what is an in the money option? Okay, now we just went over strike price. What price can an option be exercised? Okay, so again, let's go back a question here. What is call? And if we go to a call, right? Call options are agreement that give the option buyer the right, not the obligation, to buy a stock. So the key is to buy a stock. That's what a call option is. Okay. And again, if we bought Twitter call option for $35 strike price, now we know what strike price is, and the stock goes to $40, then we would say it is $5 in the money. Now, if the stock doesn't go to $35 and you own a call option and the stock goes down to $30, then that's known as out of the money. So now let me go back to Google search and put in, what is in the money option? And here it is, right here. In the money means that a call option strike price is below the market of the asset, or that the strike price of a put option is above the market of the underlying asset. So in layman's terms, what does that mean? Again, if you have a $35 call option and the stock of Twitter goes to $40, then that is $5 in the money. The price of the stock is above the price of the option. Now in the case of a put, because it's a contract to sell the stock, in the money means that Twitter is at $30 and you have a put option at $35. That would be $5 in the money on the put. Okay, and again, I don't even have to go back to Google, they already got it right here. Whereas an option that is out of the money does not. It basically means that your option has zero value on the day of expiration. Now it will be worth something. If you buy a stock option that does not expire for the year, that's going to cost money. But if you buy a stock option that expires tomorrow, if tomorrow was Friday and you were to buy a call or a put that expires tomorrow and it's near the money or at the money, it's probably not going to be worth very much. You might spend $50 or $20 or even as little as $1 or $2. I mean, believe it or not, there are stock options that are that cheap. Okay, so that is in the money and out of the money. Very important term to know. Now, this is the question I was going to ask before. What is premium? So let's put that in. What is premium option? There we go. And Investopedia.com comes through again. What is option premium? Option premium is income received by an investor who sells or writes the option contract to another party, blah blah blah. Investopedia can get wordy, so I am doing the extra benefit of giving my short answers here about stock options. So option premium is how much money is the call option or the put option worth. Is it $100? And I'll again, let me go back to TD Ameritrade, and I'll show you what I mean. Okay, so I probably should keep this window open so I don't have to keep redundancy myself and do this over and over, since I might go back. And here we go. Now I'm going to go back to Twitter. I like to trade options on Twitter. That's why, and I just know the stock very well. And here's Twitter. Again, going to the option chain, and let's click on these 20-day options. Okay, now if I wanted to buy Twitter, you can see that Twitter is at $35.18, right? Very cut and dry. You buy 100 shares of Twitter, you'll need $3,518. Okay, that's how much the stock is worth per share. Okay, now with an option, you again click on these 20-day options, and you see you got $34 calls, $34.50 calls, $35 calls, $36, and those are 20-day calls, right? And you see they're worth different prices. Now it shows $1.98 is the bid, $2 is the ask. When you're buying options, and the same is true for stocks, it's not like going to a grocery store and you just buy a can of soup. It's more like going to an auction. Okay, and the bidders, they want $1.98, and the askers, they want $2. So the people that are asking, those are I call them the bears, and these are the bulls, or maybe I got it backwards. But the buyers, they want to spend $1.98. The sellers, they want to collect $2, and the price is always in the middle. If we go out further, like if we go all the way long term, you can see that there's a gap. Like the buyers, they want $9.65. The askers, they want $10, and so you're probably going to get it somewhere in the middle, right? Now, that's option premium. So going back to option premium, these 20 days, okay, the key to knowing how much the option is worth is you have to multiply times 100. Why times 100? Because options are leveraged by 100 shares. So when you buy one call option, you own a contract to buy 100 shares of that stock at, the bid is $1.98. The ask is $2. You own 100 shares to buy that stock at $34 a share. A put, which is over here, is 100 shares at $34 a share to sell. Okay, and the puts are only worth 73 cents, and notice why that is, because the price of Twitter is at $35.18, right? So in 20 days, this put option is going to be worth 0. In 20 days, this put option is going to be worth $35.18 minus 34, so it's going to drop down to $118, and that's known as time value, and that's a question later on that I'll talk about. But this is option premium. With option premium, that's how much the stock option is worth. It's different than buying the stock. It's a contract, and the premium is how much money you're going to spend for that call or put. Now let's go, and I'm going to keep this window open. I'll just minimize it in case I have to go back here and do a little bit more brief explanation. So let's go back to Google, and let's move on to the next question. Okay, the next question is, what is intrinsic value option? Oops, misspelling. Option. There we go. Intrinsic value. Again, Investopedia comes through in the clinch. The two components of an option premium are the intrinsic value and the time value of an option. So again, that's another question you need to know the answer if you want to buy and sell stock options. And again, glad I have my Ameritrade open still. I'll show you what I mean. Okay, now again, back to this $34 call option on Twitter. Okay, the premium is, let's say, $1.99. Let's say it's in the middle. Let's just say $2 just to make the math easy. Let's say this $34 call option is worth $200 as of today, right now. Now in 20 days, the value is going to drop down to $35.18. That's what Twitter is worth. It's a weekend right now, so that's what Twitter closed at on Friday. And so you would take 35.18 minus 34, and that gives you your intrinsic value. Now, why is that the intrinsic value? Because ultimately you own one contract to buy Twitter at $34 a share, right? So if Twitter's worth $35.18 a share, and you owned a contract to buy Twitter at $34 a share, then what you would do is you would exercise your call option and say, okay, here's my contract to buy Twitter at $34 a share, right? And so now you own 100 shares of Twitter at $34 a share, but you see that Twitter, the actual value of Twitter is $35.18 a share. So you get to buy Twitter at $34 a share, and then you can turn around and sell it right now at $35.18 a share. So the intrinsic value would be $118. Okay, so that's a very important question to know. Now, the time value is all the extra money. So the extra money in that call option would be the intrinsic value is $118, but the option itself, if you were to buy it right now, if the market were open right this minute, you'd have to spend $200. So the extra money that you're spending over the $118, that's the time value. Okay, so that would be 200 minus 118, that'd be $82. So this particular option, $34 call, has $118 in intrinsic value. That's the actual value of the option, and the extra money is called the time value. Okay, so again, that's important to know as well, because you can buy options, but you can also short sell options, just like with stock. And if you were to short sell this call option, and then let's say Twitter went down, and then you would collect that time value. You would lose the intrinsic value, but you would collect the time value, and that would go ka-ching into your account. That's what I do a lot when I buy and sell options. I like to buy long-term options, which are very expensive, and then I like to sell short-term options, which are cheap. And there's a good reason why I do that. That's known as a calendar put spread or a calendar call spread. That's an option strategy. I will not go into that in this video, but just know that if you want to buy and sell options, you should know the difference between intrinsic value and extrinsic value. Okay, so moving on to the next question here. I have my little notepad. I'm going to keep this open, and I'm going all out of order here. Where is it at? Okay, going back to Google search. So that's intrinsic value and extrinsic value. Now the next question is, what is time value? So let's put that in. Time value of option. And I've already answered that question, didn't I? But it is a separate article on Investopedia.com, so I put it down as a separate question. So we went over intrinsic value, we went over time value, and so you can read this article. I already gave you the short answer, so we can bump ahead up to the next question. What is, let's Google search, go back to Google search. What is expiration date option? And here we go. Investopedia.com. Again, another question that you need to know that you can find the answer on Investopedia, and I'll give you my short answer here. The expiration date are these dates. It's very simple. On Twitter, you have options that you can buy expire in 6 days. You can go out a week further. You can go out a couple months, you can go out a whole year. Now, if I click on a different stock, and let's do the whole S&P, the SPY. This is an ETF, an exchange trade fund, and I click on those options. Look at how many different options they have. They have options that you can buy all the way out to December of 2020. That's like 2.5 years. You also have options that expire in 3 days, options that expire in 4 days, options that expire in 6 days. In other words, this is a highly liquid stock. Now, if I click on another stock, like what's a good one? How about GoPro? This might be a liquid stock, but I'll click on it anyways, and let's go to their option chain. You see there are less options on here. I'm trying to think of a non-liquid stock here. Let's see. There's one I'm trying to think of. Give me a minute. I'm actually, you cannot see this in the video, but I'm going to my iPhone here really quick. Here we go. Denny's. Denny's restaurant, DENN. And let's look at those options. Look, okay, this is not what I would call liquidity, and so I don't like to buy and sell options on stocks like this that don't have that many choices. I would rather do something like the SPY or Twitter that has lots of different choices. Okay, and actually, if you really want a good resource, you can go to barchart.com and you can go to options like this. Just click on the options and then go to most active options, and this gives you a list of, oops, I clicked on the wrong one. Most active options. I clicked on unusual option here. Most active options, and here is liquidity. Okay, Apple stock is at the top, and this changes every day. Every day that the market opens and closes, Apple happens to be at the top with over $1,200,000, and that's insane. Chesapeake Energy Company, AMD, B of A, Facebook, General Electric. Is Twitter even up here? Yeah, Twitter's up there. Look, 99,000. That's highly liquid. When you have anything in the 5 digits, that's highly liquid. All of these stocks are highly liquid. So you just pick one of these stocks. If there's a stock you like, and then you just go to town, start buying and selling options, and they will have lots of choices with lots of different expiration dates. Okay, so again, that's my short answer. The value of the option, stock options that expire long term, like in 2020, will be more expensive than the options that expire in 6 days. And the further you go out, the more expensive. It's very much like term life insurance. Term life insurance that's good for 20 years is going to be more expensive than term life insurance for 10 years. Okay, so that's my short answer on that. Now, moving on to the next question. So we talked about what is premium. We talked about an option chain here. And oops, I logged out of Ameritrade. Well, no big deal. I can just re-log back in. So let me go back to Google search and let's move on to the next question here. And the next question I have here is, what is break-even point? Let's type that in. What is break-even? And it's even got it right there. There you go. What is the break-even point in options? Break-even point, they've even got an acronym, BEP, Investopedia.com. Break-even point is the price level at which the market price of a security is a stock, is equal to the original cost. Okay, and now I'm going to give you my short answer. This is why I want to stay on Ameritrade, but I closed it out, logged it out, not thinking. So let me re-log back on real quick so I can explain break-even point. This is very important to know because this will help you calculate how much money you're risking versus how much money you can make in a given period of time. So let's go to Twitter, one of my favorite stocks, and let's calculate a break-even point. So let's say you bought a $34 call on Twitter and you spent $200. Your break-even point would be $36. Why is that? Because if the price of Twitter went up from $35.18 to $36 between now and the day of expiration, which is in 20 days on September the 21st, then the price of that call would be worth 36 minus 34, which is $200, and that's how much money you just spent. Okay, so you can probably guess why that's a pretty important number to be aware of, because you'll want to calculate your break-even points, and if you're doing calendar call spreads or calendar put spreads, it's good to know where those break-even points, and then you can calculate if it's worth the time, if it's worth the risk to buy into that particular call or put. So that's how you do the break-even point, and that gives you a benchmark on also where to set your stop loss, where to set your exits, when to take a profit, and really any way you want to slice it depending upon your risk tolerance and so forth. So it's good to know what is a break-even point on an option. Now, the last few questions that I have here written down are on basic option strategies, and I believe that if you're going to get your feet wet, if you are new to stock options, it's good to know these particular questions. So what is covered call option? And here is the Wikipedia. There's the Investopedia. So again, you can find the answer on Investopedia. What is a covered call? And the short answer to a covered call is that you can buy a call option, you can also short sell a call option. Now, if you own the stock, like let's say you own Twitter and you bought Twitter at $35 a share, and then you short sold a $36 call option, and Twitter went up from $35 to $36 and even higher if it went to $37, and let's say you sold that $36 call option, and let's say that you got $100 for that call, that's known as a covered call. And the reason is because if you did not own the shares and you just short sold the call, well, it's just like a stock. Okay, if you short a stock and the price of the stock goes up, you're losing money because you are the seller of that stock. You want to buy low and sell high, or you want to sell high and buy low. You don't want to sell high and then buy it back for higher and higher and higher prices. But because you own the shares of the stock, then you have 100 shares that are increasing in value, even though your call option is increasing in value. And so that covers any losses that you might incur on your call option if the price of the stock went above the strike price of the option. So that is known as a covered call. If you were to just short sell the call option, that would be known as an uncovered call or a naked call, and you would need the highest level of option approval on your broker. Brokers take that seriously. There are margin requirements, because if you don't have the money or the shares to cover yourselves, then you could actually lose more money than what you originally put into the position in the first place. It's the same thing as shorting a stock. If you short a stock and the stock goes up, you could lose more money than what you originally short sell the stock in the first place. So that's why covered calls is a good beginner option strategy. Uncovered calls or naked calls, that's advanced strategy, and you want to be very careful of that. You want to make darn sure that you know what you're doing before you get into that world. But a covered call, you can buy a stock out there in a stable company, and you can sell call options. You can choose call options that are higher than the price of the stock, and if the price of the stock goes down, then your call option will expire and it will be worthless. It will be worth $0. For example, if you sold a $36 call on Twitter and the price of Twitter went down to $34, then you short sold a call option at $36, which is worth $0, and let's say you got $100 for that, and then you can buy it back for $0. So you do the math, you just made $100, and that's the way covered calls work. A lot of people, they do this as a kind of safe and sound. It's good if the stock is not moving, if the market is flat. It's known as a neutral strategy. Okay, so let's move on to the next question, and this next question is very similar to a let me go back to Google search here. What is cash secure put options? There we go. And cash secured put options, and let's see if I can find it here. Selling put options. Here's an article on Investopedia, how to sell put options to benefit in any market. So I want to find an even better option. Put in the letter D, maybe that'll come it up. I want to find an even better. Oop, got to deal with the pop-up ads here. Why are call and put options considered risky? That's a good question. I'll read that article sometime. Where is a put on a put, secured put, cash secure put? Let me go back to Google search here. Apologize for the little delay. It pays to prepare ahead of time, but you must admit this is a good video. You have to admit that. It's a basic video from a blue-collar guy. I'm not a Wall Street shark. I'm not a con artist trying to sell how to day trade, make millions of dollars, and give me $1,000 or $100 a month for my virtual trading account. Secured put. I offer all of this information for free, and I feel a nice, good, warm, fuzzy feeling doing that. So going down, cash secured put Investopedia. Now that's gotta find it. Introduction to put writing, okay, or short put definition. Either of those articles would be good. So here we go. Introduction to put writing. That's what you're doing. And for some reason, when you buy a call or you buy a put, you're buying a call or buying a put. But when you sell a call, meaning short sell or a put, you're known as an option writer. You are writing an option. Now that's just, to me, extra verbiage. Just know that you can short sell or buy. Doesn't matter. You can take the long side or a short side. So here it is. Now, selling cash secure puts is the same idea of selling covered calls. Cash secured means you have the money in your account in case of the price of the stock goes below the strike price of the put option. Okay. Again, if you didn't have the money in your account and you just start selling puts, that would be known as an uncovered put or a naked put. And selling naked put, again, you need certain margin requirements depending upon what the particular rules of your broker are. So you can read this article here, Introduction to Writing Puts, and people do it for income. It's good articles, and all these questions you can go to town and just read up on Investopedia.com. Okay, now moving on to the next question. Let me go back to Google search, back browser. What is debit spread? Now we're getting into some option trading strategies. And again, here's the article. The short answer to a debit spread. I'm going to go back to my Ameritrade here, click on my option chain, and let's say that I were to go 48 days out and I were to buy a $35 call on Twitter at $219, or the bid is $219, the ask is $221, and then I were to sell a $38 call. So I'm simultaneously buying a call and selling a call. Now notice there's a $3 spread, right? You have this $38 call and you have this $35 call. So you're long on the 35 and you're short on the 38. So how would that work? Well, you spend $220. Again, what's that called? Premium. Okay, and then you own a call option on Twitter, but then you are writing a call, right? You're selling a call and you're collecting $103, the price in between the two. So you spend $220, but you collect this money. So 220 minus 103 would be 117. So you end up only spending 117. And now if the price of Twitter goes to $38 between now and expiration, then you basically have a call option that has $3 in intrinsic value, and the price of this call would go down to 0. So for a, what did I say, $117, your investment would turn into the intrinsic value of the 35 would be $3, and then you add the $117 you collected, $417, and your original investment was $117, so you'd make $300 on a $117 investment. That's known as a debit spread. Okay, a credit spread is the other way around. Like, let's say you believed that Twitter was going to go down or it wasn't going to go above a certain price. So what you might do is you go to these 48-day expiration date, you look at these options, and you would sell a $36 call, and then you would buy a $38 call. So you collect, let's say, 172, but then you would spend 103. So 172 minus 103, that would be what, $69. So $69 would be credited to your account, and your hope, you're making a bet that the price of Twitter will stay below $36 between now and 48 days, and if it does, then you keep that credit. That's known as a credit spread. If it goes above, and worst case scenario is if it goes over $38, then the spread is $38 to $36. That's a $2 spread, and you would subtract the premium, which was $69, so that's $131. You would lose $131 if you were to sell one credit call spread, and you were to sell 36 and buy a 38, and the price of Twitter went above 38 between now and 48 days. So again, that's questions you want to answer after you answer all those other basic questions. What is a call option? What is a put option? And so forth. Okay, so now I'm going to log out of Ameritrade since I went through all the questions, and just as a quick review here, go back to Google. The questions are as follow. 1, what is a call? And you can find this, Google search it. You saw all the articles are on Investopedia. 2, what is a put? 3, what is an option chain? 4, what price can you buy or sell the stock if your call or put option is exercised, and that's known as the strike price. So if you want to find that on Investopedia, just put in what is strike price option. Next question is what is premium, and then the 6th question, what is intrinsic value? 7, what is in the money and what is out of the money? That's kind of one question. And then 8, what is expiration date? 9, what is time value? Remember, we went over intrinsic value and time value. They are interrelated with each other. And then 10, what is a covered call? And 11, what is a cash secure put? What is a debit spread? What is a credit spread? And 14, what is break-even point? The break-even point is how much money the stock needs to go up or down for you to break even, so you don't lose money. You're basically playing with the house's money. And last but not least, I saved this question for last. This is question number 15. What is risk reward ratio? And here it is in Investopedia. This might be the #1 most important question that you need to be able to answer before you invest in anything. Okay, you need to know how much money are you risking, how much money could you lose if things go wrong, how much money could you make. A lot of day traders, they set a rule like, I'm not going to lose more than 2% in a single trade, and they hope to make 10% or maybe 5%. I don't know. Everybody's risk reward is different. And the difference with stock options is now you have a time limit element. And a lot of normal investors, people that just invest in stocks, and they don't like stock options because they expire. They believe stock options are more risky than stocks, and they are dead wrong. But it's not for me to argue with people and to try to force feed people the ideas that I have about options or about anything. If you want to believe that stocks are more risky than options, you are welcome to do that. But in my judgment, in my experience, that is dead wrong. But I can talk about that in another video. Okay, but go over risk reward ratio, and that's all 15 questions. What is a call? What is a put? What price can you buy or sell the stock if the option expires? What's an option chain? What is premium? What is intrinsic value? What is time value? What is in the money versus out of the money? What is a covered call? What is cash secured put? What is time value? What is expiration date? What is break even point? What is a debit spread? What is a credit spread? And finally, what is risk reward ratio? All of these questions you can find the answer to on Investopedia.com. It is worth your time to learn these things. You spend how many years of your life getting that college degree, that high school diploma? You spend half your life, or maybe a third of your life, going to school to get your 9-to-5 job earning $15 or $20 an hour. Why can't you spend a few hours a week, maybe 30 minutes a day, reading just one article a day? And then in a month or two, you're ready to make some money. If you've been watching my videos, you know that I have been making money in the market. I'm currently up at about 18% return, and I'm doing it all on option strategies. So thank you for watching this video. I hope you enjoyed it. As always, if you have any questions, feel free to leave in the comments. And other than that, I will see you in the next video, and thank you for watching.